in the longer term, after this next recession, that's where the sweet spot is going to be for my firm and for precious metals. After this next recession, when deficits spike to $5 or $6 trillion for that first year, it's going to require a tremendous amount of monetization. And here's why they have to do it. I don't think Warsh has a choice. The bigger the balloon, the more air you force into a balloon, the bigger it grows, the louder the explosion, correct? So they know, they being the Treasury, they being the Fed, and they being the president, they have to keep, number one, they have to keep interest expense down since all of our debt is floated on the short end. So it's all T-bills.
Gold and silver remain in focus as investors weigh persistent geopolitical tensions, central bank policy, and growing concerns about slowing global growth. While short-term price swings continue to grab headlines, many analysts believe the bigger story is unfolding beneath the surface. That's exactly what Michael Pento argues. He says the real opportunity for precious metals may not come from today's market volatility, but from what happens when the next recession forces policymakers to respond. Let's break down his outlook.
We had about a month ago in the heart of the memorandum of understanding days which I predicted to be a pretty benign reporting season for inflation, which is what it actually was. It was a second derivative decline. It went from 4.2 to 3.5, which I predicted, which was rocket fuel for gold. But what cut the legs out from under the gold market was right after that CPI print and the rather disastrous, in my opinion, non-farm payroll print, which I also predicted, which is why I went long the miners, which is why I went long gold. We saw the war go kinetic again. And oil prices spike, which means, you're not going to get much of a decline in the second derivative at all. But the first change is going to be, back close to mid threes again. So that's just and then you have news today. There's a 10-day ceasefire maybe, and the miners are ripping. So go ahead. If you want to trade the mind swings of the people involved here, then, it's up to you. Well, here's what I know. Here's what I'm very confident in. In the short term, anything could happen. In the very short term, because you're just subject to the president's Twitter feed and social media account. Anything could happen. They're begging for a deal. We're days away from a deal. We're going to just destroy the country, blow them back to the Stone Age. So you are subject to that. You know that, right? But in the longer term, after this next recession, that's where the sweet spot is going to be for my firm and for precious metals. After this next recession, when deficits spike to $5 or $6 trillion for that first year, it's going to require a tremendous amount of monetization. And here's why they have to do it. I don't think Warsh has a choice. The bigger the balloon, the more air you force into a balloon, the bigger it grows, the louder the explosion, correct? So they know, they being the Treasury, they being the Fed, and they being the president, they have to keep, number one, they have to keep interest expense down since all of our debt is floated on the short end. So it's all T-bills. So by raising interest rates, you're going to add to that interest expense, which, by the way, we are now paying $24 billion a week in interest payments. Did you hear that? That's over $1.2 trillion a year on the interest on our debt. That debt rolls over, our T-bills going higher, you're going to pay a higher and higher interest rate, Dunnigan. They need to get that down. But here's the biggest reason. That's one reason. It's a pretty big one. But when you have asset prices that are so deformed, when you have the total market cap of equities at 235% of GDP, where the normal ratio should be like 90%, when you have the price to sales ratio that's 45% above historical normal levels, 45% price to sales. So no matter how you look at the stock market, it's so overvalued. If we don't constantly push new money supply, new credit into that system, it will implode. And when it implodes, you're not talking about going from maybe 110% of GDP back down to 90 or maybe 70. You're talking about going from 235 back to maybe 90. So that's a violent move of more than 50%. Think about the condition the banks are going to be in when home prices crash back down to earth, right? So the home price to income ratio is at a all-time record high right now. What's going to happen to the banking system and to the economy when the stock market and the home prices crash? What's going to happen? They know they have no choice. They don't even want to think about it. That's why they came up with this 2% inflation target, because they don't even want to deal with a recession, or even the whites of the eyes of a recession, because they know how pernicious it's going to be.
Michael Pento's message is straightforward. Don't let daily market noise distract you from the bigger picture. He believes recent moves in gold and silver have been driven by changing expectations for Federal Reserve policy, inflation data, and geopolitical events. While those factors can create sharp short-term volatility, Pento says they are not the main reason to own precious metals. His core view is that the next recession could become the real catalyst. If economic growth weakens significantly, he expects government deficits to expand sharply, with policymakers relying on more fiscal stimulus and Federal Reserve liquidity to stabilize the economy. Historically, periods of rising debt, easier monetary policy, and declining confidence in paper currencies have often supported demand for hard assets like gold. Pento also warns that today's economy faces multiple challenges at once: high government debt, elevated stock valuations, expensive real estate, and growing pressure on credit markets. Rather than reacting to every headline, he encourages investors to stay focused on long-term fundamentals and be prepared for major shifts in the economic cycle.
Because I do not believe for a second, if we have those kind of deficits and that kind of recession, that's really going to be a depression, that the government's going to sit by and do nothing. They're going to be talking about sending just more stimmy checks out. And, deficits will go through the roof. There's your baseline deficit. So going into the other recessions, our baseline deficit was a few $100 billion. Now it's $2 trillion or thereabouts. We've seen times like this before. We've never seen anything like this before. We have never had a triumvirate of bubbles. I mean, I think I coined that phrase, and it's still in existence. Following the COVID outbreak, 2020, we have bankrupted our treasury. We now have an insolvent nation, in my opinion. Assets and liabilities. That's new. And so when you have real estate, equities, and credit all in a massive bubble, and the Treasury's balance sheet has already been severely depleted, decimated, that's what took us out of all the other recessions. Well, what happened? Well, the government spends trillions of dollars by default and proactively, and the Fed monetizes it all, and it worked because the last recession, I think the debt to GDP was like 60%. Now it's 123%. In the 80s, it was 35%. So you're going to put tremendous monetary and fiscal strain the next recession to try to paper over that triumvirate of bubbles. So there's a good chance the dollar collapses. There's a good chance that long-term sovereign bond yields rise. So there's nothing like we've ever seen this before. So I want to get that. I want to be very clear on that. So I have a proprietary financial conditions index. I look at credit spreads. I look at the 5-year break-even spread. I look at commodity prices. I have a 12-point model that's been rigorously back-tested and updated. It used to be 20-point model. I honed it down to 12, trying to get this process as simple as possible, as frictionless as possible. So when I see the first warning signs, I can react. And I'm not doing it yet. I am not taking steps now to protect. And I can't believe I'm saying this. After listening to me, you'd think I'd be in a bunker eating, beans and MREs, but I'm not doing that yet because I need to do it. I'm a fiduciary. I have to do what's best for my clients. I'm trying to make money as carefully and as safely as I possibly can, as long as these bubbles exist and persist. But the real upside, I believe, the potential upside is for generating alpha is to be out and short when this bubble breaks. And it will. I can assure you this, we have not repealed the business cycle. Recessions have not been outlawed and eliminated. We will have another one. And the nucleus of the issue is going to be in the credit markets. I don't know if the catalyst is going to be the bursting of the AI investment bubble. I really don't know, and I really don't care. I know what I'm looking at. I know when I have to react, and I will be there before the majority of the damage is done.
Whether Michael Pento's outlook proves right or not, the key themes to watch remain the same: Federal Reserve policy, government debt, inflation, and global geopolitical developments. Those forces are likely to shape the long-term outlook for gold and silver far more than day-to-day market moves. If you enjoyed this analysis, please like this video, subscribe to the channel, and turn on notifications for more updates on gold, silver, and the global economy. What do you think? Will the next recession become the biggest catalyst for gold and silver, or do you see another factor driving the market? Let us know in the comments below. Thanks for watching.